to our guest. Mixo Das has joined us, and in a bit we are going to be joined. Mixo Das of Nomura has joined us on the line from Singapore. We have Geoffery Dennis joining us from the United States, and in a bit we will also have guests joining us from Hong Kong. Good morning to Mixo, and good evening to Jeff, and thank you, Jeff, for even staying up for us. Well, Mixo, first to you. The big question that we are asking today is this the 2003 moment? The 2003 moment when Alan Greenspan said accommodation will be removed at a modest pace. So should we take this statement of Yellen indicating higher growth and lower unemployment for 2017 positively?
Actually, we have a slightly different take on this, where we are seeing U.S. economy getting stronger in 2017, in fact, having a negative effect on EMs. And I'll tell you why. There's two parts to the U.S. growth story, right? One is the structural recovery from the recession that we have been seeing and has been ongoing. It's been building momentum over the last few years, which Yellen also highlighted in her speech yesterday or this morning for guests in the U.S. The other part is related to Trump and what his fiscal policies is going to do to growth expectations going forward. And really, when you look at the impact on emerging markets, the reason I fear it is because the higher rates, the resultant higher rates in the U.S. do get translated very quickly to emerging markets and higher rates and portfolio outflows. But the better growth because of fiscal policies, especially Trump's fiscal policies, don't actually spill over into emerging markets because of its very protectionist nature. So from that angle, we are actually a little bit cautious going into 2017. We expect some downside in the MSCI AEJ index, especially in the first half, followed by some recovery in the second half.
Okay. Geoffrey, good morning. What are your thoughts? We had the rate hike, of course, which was penciled in. Maybe slightly hawkish that there are now 3 more rate hikes penciled in for 2017 compared to 2. What's your thoughts on this long DM short EM trade which is currently on right now? Do you see reversal of that, or do you see continuity of that?
Actually see that emerging markets are going to hold up pretty well against developed markets going forward. First of all, the vast bulk of this trade out of EM into DM occurred in the week after the U.S. election, because all the excitement over the prospects for the economy after Trump was elected. Obviously, we've seen some more of that in the last 12 hours, not quite 12 hours, nearly 12 hours since the Fed statement. But actually, from 1 week after the election until just a few hours ago, EM was making a nice recovery against DM. So while I agree actually with the analysis of your previous speaker, we have a slightly different scenario, and that is that we just don't think there's going to be that degree of pickup in U.S. growth in 2017 to warrant a further rise in bond yields from these sorts of levels. And if that is true, we may well find that in the end the Fed doesn't raise rates 3 times. Our forecast is they're going to raise rates twice, and we think the bond market from here will not become completely unhinged. So we're looking for opportunities to add to emerging market equities, not fearful of sharply higher growth, sharply higher inflation, an aggressive Fed, and much, much higher bond yields. But of course, that all turns on what the ideal macro scenario is, and I understand that there's a variety of macro scenarios out there. But no, we would not be rotating into DM equities at the moment from EM.
Okay, so Mixo, okay, we have 2 opposing views. One from UBS believing that, the EM trade will pick up, and Mixo Das of Nomura saying that, no, it's developed markets that could continue to perform well. So Mixo, what do you do with a market like India then? Because we have seen a lot of FII outflows this year. Do you see that continue even in the first half of 2017?
Yeah, just to clarify my view here, like when I said that we expect the EM markets to underperform DM, this is really, I would say, more a 6-month kind of view, okay, where we have, since the middle of this year, since after Brexit, we have been pushing a DM to EM rotation, and that has been largely because our understanding that, growth in developed markets remains quite modest, and whereas in several areas in EM, India inclusive, we are starting to see an acceleration of growth, and that's really what's going to drive the multi-year performance. So from a multi-year, 5-year perspective, I do think that a EM versus DM trade could still outperform, and but in terms of timing, I would see that coming through mainly in the second half of next year. And the reason is simple, because we see bond yields actually going higher in the first half, dollar getting stronger, portfolio outflows from India and other emerging markets continuing.
Okay. Well, actually, Jeff, I wanted to ask you more this comparison with 2003. Accommodation will be removed at a modest pace. Those, iconic words, legendary words from Greenspan. Is it looking like we are on that strong a growth path that the U.S. economy, when the mother economy grows, it can take all the babies along?
No, I don't think we are. We just don't see that whatsoever. First of all, we think that growth will remain relatively sluggish. Our forecast for 2017 is 2.4%. That's not changed since the U.S. election. We also think that core inflation will remain relatively low, even if, of course, headline inflation is going to go up in the next few months because of the dropping out of the 12-month comparison of the oil price plunge of late last year and early this year. And what that means is we think the terminal rate that the Fed cycle will end is quite a bit lower than it was in 2007, when, of course, the Fed, I think, stopped at somewhere between 5 and 5.5%. So I think the cycle is different. We're still in a massive deleveraging cycle around the world, where debt overhang is slowing growth. It's not so much slowing growth, it's keeping growth fairly subdued. You've got a very soft global trade environment. So it is not going to be as robust a cycle as we had in 2003 to 2007. Therefore, you're not going to get as much Fed. And therefore, almost certainly as well, you're not going to get as much in the way of increases in long-term bond yields from here. Now, clearly, my view, like your other speaker's view, is very much premised on how, to what extent this growth comes through. It's a macro call. We're just making the call that we think growth will stay fairly steady. Bond yields will eventually level out and probably start to come down a bit. Dollar is not that strong from here. This is a better liquidity environment for 2017 for EM once again. Don't think we're going to blow the doors off. It's not going to be a huge year or anything like that, but we just think rotating into DM from here is not right, because we just don't see the cycle being as strong as it was in that earlier period.
Okay, let's get one more voice in. Ken Peng, Asia Pacific Investment Strategist at Citi, is also with us. Ken, good morning.
Morning.
What's your sense? We've had the rate hike, and of course, the consensus says, or near consensus is that we might have 2 or 3 more rate hikes next year. In this context, how are you positioning your bets between developed markets and emerging markets?
Well, first of all, I think the near-term risks are pretty significant. It is kind of setting up markets for disappointment, similar to what had been done with the first rate hike last December, and it is likely to be more impactful on emerging markets in the near term. So I'd say that in the next couple of months, we're probably facing some downside risk, not just to equities and risk appetite, but also to bond yields. I think this is a short-term, I think tactical position. While the medium to long-term view, I think, is still very much anchored on whether we get this fiscal boost.
Okay. Ken, what would you mean by the near-term worries? Last time around, we saw this big renminbi devaluation play out in January, and that roiled markets. We almost were expecting recession. Do you see some such dislocation this time?
Well, the amount of weakening in the renminbi, the amount of depreciation that we've seen in the past 2 months is a lot more than what we saw last August. So I think it's the markets becoming more adjusted, more tuned to the style, the new FX regime that PBOC is managing, which is to maintain stability versus a basket, right? So when you look back to, say, July, the effective exchange rate for the renminbi has been fairly stable. In fact, it has been stronger because the renminbi has appreciated versus non-dollar currencies. So and I don't think this necessarily means that we're going to see a significant risk of further depreciation. This is purely a function of a stronger dollar. Now, the risk, I think, going into next year is whether friction between U.S. and China will cause the RMB to devalue even more. I think the risk is there, but at least based on President-elect's cabinet picks, it seems a very pro-business setup, and I think it's going to. It doesn't have to be extremely negative for China or the EM space in general. So looking beyond this short-term negativity from a more hawkish Fed, I wouldn't be so worried about EM assets.
Okay, so over the long term, over the next 12 months, what kind of move do you see for global risk assets? Because the one sign we got from the Fed talk is that the US economy at least can perhaps shed its long period of, stagnation and return to a
get that type of fiscal policy, then I think they would be even more confident about the economy, and see probably normalize rates faster. So now, if that happens without the trade frictions, then I'd say that it's a very positive scenario. But we're probably going to get a bit of both.
Oh yes.
So yeah.
Yeah, of course, that trade friction is what we were worried about. Mixo, therefore, that last question to you. At the moment, do you see a lot of downside for markets like India as this fear plays out? Does the Nifty, for instance, pierce 7950?
Actually, not a lot of downside for India. India, in fact, is our top overweight market in AEJ at this point. So I think after the demonetization, we've got the Indian market at a very good level, with still what our economists believe is not a very long-lasting impact. So if we get like 2 quarters of negative impulse on GDP, and then we get to a much more normalized path, that should make for very strong earnings growth in the Indian market. And at these valuations, the market looks quite attractive. I would still expect a little bit of downside given the risk that I mentioned, higher rates in the U.S. impacting flows from EMs, and some cyclical slowdown in the commodity and industrial space, as well as cyclically rising China risks. All these will combine to put some downside pressure on EM assets in the first half. India will be part of that, but beyond that, I would expect the Indian market to do quite well.
Yeah, in fact, I read that note that you wrote last week, Mixo, about India being your top overweight in emerging markets. What kind of absolute returns can investors expect in India next year?
Oh, we don't specifically have a numerical target for the Sensex as such,
Okay.
but I would say double-digit numbers are very easily possible.
Okay, and Jeff, what about you? You've in any case been bullish on India for a while. What kind of an upside do you see for the Indian market, say over the next 6 to 8 months?
Well, certainly it's one of our overweight markets as well, so we agree on that one. And our call for 2017 is that emerging market equities will be up somewhere between 5 and 10%, perhaps close to 5 than to 10. It'll be a slow grind as opposed to being an explosive move higher. That's consistent, we think, with our macro view. So India could get a little bit more upside than that, possibly around the 10% level. But it's an outperform in our view, but you're talking about outperforming what's going to be a positive year next year, but a fairly sluggish year. And so we're not looking for spectacular upside, but we agree with the previous speaker again that the demonetization process has been very disruptive, but it's probably not going to last for more than 6 months as our base case. Growth will eventually come back. It's a good reform. The market will benefit from that, but upside we would see no more than 10% for the year.
Right, and a similar question to you, Ben. What is your expectation at Citi about the pecking order in emerging markets, and whether Indian equities should brace itself for more losses or less?
No, I think our view is that commodity-related emerging markets are actually going to do pretty well, because with this whole policy expectation, commodity demand should be stronger. And meanwhile, with the OPEC deal, I think the supply side is actually more managed. So that would tend to favor Latin America among EMs, and they have been challenged quite a lot lately, and they've seen a lot of declines, and they probably will continue to, in the next couple of months during this uncertainty. But I think they probably are building up. Well, it's good to. I think it's worthwhile to watch them and start building positions, into a sell-off. I think India, it is our favorite among Asian EMs as well, because effectively this anti-corruption and demonetization is basically buying time, right? So it's kind of resetting the Indian equity market for better gains. And I think the Indian economy is more insulated from these external impacts because it does not depend so much on exports or external debt, right? So I think that in terms of resilience, India ranks high. In terms of growth, it ranks high, and it also has some potential reform dividends.
All right, Ken, Mixo, and Geoffrey, thanks a lot for talking to us and making sense of this big development.